right. So welcome everyone. My name is Luca Panarelli. I'm a tax partner in our technology and emerging growth practice here at Witham, and I lead our digital health sector. My clients pretty much run the spectrum of early stage startups to large multinational unicorns, which uniquely positions us to be able to advise at all levels of the company lifecycle. I'm joined today by Taylor Burns. Taylor, can you give a quick intro?
Yeah, thanks, Luca. My name is Taylor Burns. I'm a senior manager and leader of Witham's Healthcare Valuation Services Group. I bring over 14 years of experience valuing healthcare entities across a variety of specialties and modalities, with a focus on digital health, MSOPC structures, and navigating the regulatory guardrails that shape this space. My work centers on fair market value opinions, commercial reasonableness assessments, and strategic analyses for transactions, joint ventures, and minority investments. I also support clients and their legal counsel in litigation and compliance matters throughout the entire healthcare ecosystem. Excited to be here today to break down the valuation challenges and opportunities that are really shaping the space and the future of digital health.
So today, what I wanted to break down was why valuations in digital health are so different and why they're so important, compared to traditional tech businesses. From the regulatory hurdles and clinical evidence to MSOPC structures, tangible assets, and the impact on fundraising and equity, we're exploring the real forces that shape the value in this sector. Whether you're a founder, an operator, or just curious how digital health companies are measured, this conversation will give you the framework that you need to understand what truly drives valuations. All right, so let's dig into something every founder, investor, operator in digital health cares about: valuations. Why is it such a big deal in this industry compared to others?
It's a big deal because digital health isn't just tech. These companies operate in a domain that's shaped by regulation, clinical outcomes, and reimbursement. So valuation in this space really becomes a signal of trust, risk, and long-term viability.
Right. And I guess unlike maybe the typical SaaS startup, the growth curve looks totally different.
Yeah, it does. Digital health companies often have a long sales cycle. They often have long or big upfront costs. Think FDA clearance, clinical validation, integration with EHRs. Strong valuations here can help them raise the capital they need without giving away the company.
And I guess, partners look at valuation too. Payers, health systems, even pharma in some cases.
Yeah. In this space, a credible valuation tells partners, hey, this company is stable, it's scalable. It's almost like a stamp of legitimacy, especially in a sector where safety and compliance matter.
Right. And then there's always talent, right, to consider as well.
Yeah. Things like, equity compensation, that would run straight through the valuation. That would set the strike price for stock options. It would shape how employees think about upside in a space competing for AI engineers, clinicians, and data scientists. That matters a lot.
No, absolutely. And I guess, big picture, valuation isn't really just about a price tag, right?
No, in digital health, it's a strategic asset. Valuation affects fundraising, compliance, partner confidence, and talent retention. It's basically the backbone of how these companies scale responsibly in one of the most regulated sectors out there.
Right. Totally agree. All right. So pivoting a little here, let's get into some of the other big questions in this space. Why do digital health companies get valued so differently? What actually drives, that difference?
Yeah, well, that difference is real. I would say it's primarily because digital health operates in a completely different environment. Let's start with regulation. So traditional tech can ship and iterate fast. Digital health, not so much. With digital health, you got FDA oversight, HIPAA requirements, CMS rules and guidelines. All of this stuff creates barriers to entry, and companies that clear those barriers often get rewarded with higher valuations.
Right. And that's kind of tied directly to reimbursement too, right? So in tech, you might sell software. Digital health, you may depend on payer reimbursement for generating revenue.
Yeah, and if you've secured reimbursement codes or strong payer relationships, investors are going to view your revenue as more durable. That's why companies with clean reimbursement pathways tend to command premium multiples.
And what about clinical evidence, right? I mean, that's something, the traditional tech company likely doesn't deal much with.
Yeah, that's right. Most tech companies, they never run a clinical trial. They never need to. In digital health, clinical outcomes can make or break adoption. If you have published evidence showing that you're actually improving patient outcomes, that's going to dramatically reduce adoption risk, and it's going to boost valuation results.
Right. And then there's data, obviously, right? So healthcare data, sensitive, heavily regulated, but very powerful if used correctly.
Yeah. Strong data security, privacy compliance, interoperability. These all play into valuation. So companies that can safely integrate with EHRs and fit into provider workflows, those companies are going to scale faster, and investors are going to price that in.
I guess we should touch on the market access a little bit, right? So scaling in healthcare can be just harder, right?
Yeah. Traditional tech can go global overnight. Digital health, on the other hand, they face state-by-state regulations, fragmented healthcare systems, complex contracting. So companies that already have strong provider networks or major health system partnerships are going to have significantly higher strategic value.
Right. Yeah, absolutely. And I guess let's talk about the risk profile too, right? So clinical liability paramount probably in this area.
Yeah, it is. Especially early stage digital health companies. Those early stage ventures are going to face more regulatory risk and clinical risk. So discount rates for those organizations are often going to be higher until they clear these key milestones like FDA approval or payer coverage. Once they clear them, valuations usually jump up because the risk gets priced out.
Right. So bottom line?
Bottom line, valuation in digital health, it's about regulatory defensibility, clinical proof, payer adoption, and how well you integrate into the healthcare ecosystem. Those are the levers that investors care about, and they're what make valuations in this industry so distinct from traditional tech.
So let's move into another interesting part of the valuations in digital health, right? So intangible assets. A lot of these companies are building proprietary platforms, algorithms, data, brand trust. These aren't physical assets, obviously, but they drive a lot of the enterprise value, right? So maybe touch on that and why that is.
Yeah, they are big differentiators. Let's start with proprietary algorithms. So in digital health, an algorithm that can reliably diagnose, predict, or personalize medical care, that's essentially IP. That's intellectual property. If it's validated, or better, if it's cleared by regulators, it becomes a real moat. Investors like that because that means defensibility and scalability.
Right, and the more an algorithm improves with use, the more valuable it becomes, obviously, right? And patient data might be the even bigger piece of value there, right?
Yes, it is. Patient data, especially high quality longitudinal patient data, that's gold in this space. It fuels better AI models. It enables personalization. It becomes incredibly hard for competitors to replicate. The key, though, here is privacy compliance. So HIPAA, GDPR. If you're not managing this data correctly, the asset turns into a liability really fast.
Right. And I think one of the items that potentially gets overlooked at times when you're thinking about this, or when founders are thinking about this, is the brand reputation, right?
Absolutely. Reputation and trust is everything in healthcare. A brand that clinicians and patients actually rely on, that holds real value. It's going to accelerate adoption, reduce churn. Investors pick up on that pretty quickly.
And I guess to sum this up,
proprietary algorithms, exclusive data sets, trusted brand name and reputation, these all boost valuations and they signal long-term viability.
Yeah, and I think there's another element to this that we should touch on a little bit too. Just the valuation of these assets can be critical in another area of the income tax code when it comes to QSBS, right? So QSBS is qualified small business stock, right? Of the many requirements that it has, one of them is that 80% or more of your assets have to be used in a qualifying trade or business. Traditional healthcare businesses typically do not qualify. Tech-enabled platforms, or even the MSO in terms of a management service organization, can potentially qualify. So the valuation of those assets really contribute to the argument or the case that you can make that 80% or more of your assets are used in a qualifying trade or business, which would be on the tech side, which would be on the management side, versus the traditional healthcare side. So, having a valuation for those assets and being able to track where they are can really buy you a lot of favor in terms of making that QSBS argument when it comes time to selling your shares. Another area that is, really important for the digital health sector is operating within the MSO-PC structure, right? Large number of our clients operate in this space. You're required to, if you're providing medical services to some capacity, and that structure exists to satisfy the state regulations and some of the requirements that come with providing those medical services. But with that structure also comes the importance of operating at an arm's length standard, right, and having an appropriate management fee. So the big question I get all the time is, why does setting the management fee at fair market value matter so much?
Well, it matters for two reasons: accurate valuation and compliance. On the valuation side, the management fee is what determines how much revenue is actually flowing into the MSO. The MSO is here, this is the entity that the investors, non-medical investors, are buying into. If that fee is too low, the MSO looks smaller and less valuable. If it's too high, that's going to raise red flags about whether it's sustainable or artificially shifting income.
Right. And, you know, to elaborate a little bit on that, right? Investors want the MSO's revenue to be real, defensible, not something that would collapse under scrutiny, should reflect, the general economics of the entire group, right? In terms of the revenue that's being generated.
Yes, that also ties into to the compliance piece of this. Regulators expect management fees to reflect a true fair market value measurement for the services that are being provided by the MSO. Services, things like staffing, tech infrastructure, billing, admin support. If the management fee is inflated or manipulated, you're going to run into issues with corporate practice of medicine rules, tax authorities, maybe even anti-kickback concerns.
Right. And so getting the fair market value right is a legal safeguard.
100% legal safeguard. A well-supported fair market value fee is going to protect the company's regulatory position. It's going to keep the business audit ready. From a valuation standpoint, it ensures that investors are seeing a clean and compliant revenue stream, one that they can trust.
So if you're a founder, CFO, what's the takeaway?
Takeaway would be treat your management fee as both a valuation driver and a compliance checkpoint. If you get it right, you strengthen your investment narrative and you minimize your regulatory risk. If you get it wrong, then you create headaches on both fronts. I would also say that an out-of-sync management fee can create significant tax deficiencies among the group. So whether or not you're consolidating tax returns, the management fee could create scenarios where one entity is taxable and the others aren't, when they should all be operating at a smaller profit margin.
Yeah, I think that's the way that I most often become aware of maybe an inequity or imbalance with regards to the management fee, right? With a lot of these digital health companies in their early stage years, right, they're scaling quickly. They're spending a lot of capital. They're usually operating at a consolidated loss, right? If you think about it from a group perspective. And, the management fee tends to be one of these things that, isn't thought about in the moment or isn't revisited as often as it potentially should be. And we get to the end of the year and you find yourself with, one of the PCs maybe in income because they've brought in so much revenue and the management fee hasn't necessarily been readjusted to, for that level of revenue. That creates a huge tax inefficient, structure and, could leave a lot of founders surprised with the tax bill at the end of the year that they were not expecting. I mean, obviously valuing it annually could become a burden. It's not necessarily necessary depending on how quickly the business is growing, but it is something that you should have on your mind and revisit, fairly often during the year. Okay. So, with this industry group in digital health, right, there's a lot of scaling companies. A lot of them have really intensive capital needs and, a lot of them are raising capital pretty often. And that process can be a headache and could be scary, right? There's a lot that goes into it. So let's get into something. Let's get into that a little bit more and specifically how valuations can shape, the capital raises and equity compensation and why that's such a big lever in these moments.
Yeah, valuation here it would set the foundation for everything. During a capital raise, okay, so the valuation is going to determine the price that investors pay. In digital health, you do have a situation where revenue often lags behind because companies are having to work through regulatory approvals, clinical validation, payer adoption. So here, investors are going to rely heavily on valuation as a way to price risk and ultimately long-term potential.
And depending on where the valuation lands, right, founders can give up more or less of the equity in the process.
Yeah. A higher valuation would mean less dilution for the team, whereas a lower valuation would mean more dilution. But sometimes you can accept that to bring in the capital needed to clear a regulatory milestone, for example, or to unlock additional reimbursement opportunities. That decision tree just really goes to underlying strategy.
Right. When we think of equity compensation, right, that's such a powerful tool for some of these businesses. It's a way to preserve capital. It's a way to, attract the top talent that you can and retain it, right? So what role does it play with regards to that?
With regards to valuation, valuation would determine the strike price for stock options, for one. So that's going to shape how employees think about upside and reward. In that case, a higher valuation would, to the employees at least, it's going to signal stability and traction, even if it makes the options a little pricier to exercise. On the other hand, a lower valuation would increase potential upside for new hires, but it may signal earlier stage risk that a more established entity would not have.
Right. And, in this industry specifically, the talent that you are, competing for, AI engineers, right? Clinicians, data scientists, they obviously pay close attention to this stuff. They know their value in the marketplace.
Yeah. And in this industry, for those types of people, equity is a big part of the value proposition. That ties back to why it's so important to have a well-supported defensible valuation. That's ultimately going to help with retention.
Right. And, I think on a consistent theme that we've, been discussing, right? Valuation doesn't end up as just a number on a term sheet.
Yeah, it's more than that. It shapes dilution, investor confidence, employee incentives, and ultimately how the external market views your long-term potential. I guess put another way, in digital health, valuation is both a financial signal and a strategic tool.
So let's talk about how some of these big industry trends that we're seeing, right? Like telehealth adoption and AI-driven diagnostics. How do they show up in a forward-looking valuation model, right? Because these aren't just headlines, right? They obviously affect the math that we're talking about.
Mm-hmm. Yeah. Let's start with telehealth. So with telehealth, when adoption rises, analysts are going to bump up revenue growth assumptions because the total addressable market gets bigger. It's also going to lower the cost to acquire new patients. That in turn is going to improve the forecast across the board.
I guess AI would play a different role here, right? AI-driven diagnostics can dramatically improve margins over time, right? Especially if they reduce clinician labor. If the tech is validated or cleared, that lowers the risk, which means a better discount rate in those models.
Yeah, it would. There's also a reimbursement angle here. If CMS and commercial payers support telehealth or RPM or AI codes, cash flows become more predictable and the forecasts might become more aggressive. If reimbursement is uncertain, valuations are going to remain conservative.
And, I guess we can't forget about provider behavior, right? Trends like burnout, capacity shortages, all affect sales cycles and retention metrics, right? Which obviously, again, huge in the projections.
Yeah, huge in the projections. Just throwing out some more valuation terms. These would also influence, net revenue retention, costs to serve, long-term margin structures. I think the bottom line here would be that the market trends shape assumptions around growth, margins, risk, and exit potential. They're central to how investors and operators build credible, forward-looking valuations in digital health.
All right, so let's just reiterate something for the founders and CFOs in digital health, right? That they really can't afford to get wrong. But, obviously, topic being the valuation that we're talking about, not just for fundraising, but for compliance, audits, and even employee equity, right? What's your top advice here?
First off, I would say build your valuation on evidence, not just vision. In digital health, investors and auditors expect documentation on a lot of fronts. So your regulatory milestones, your clinical outcomes, your payer contracts. Secondly, I would say make sure that you're refreshing your valuation at key inflection points. These businesses are going to progress through major milestones, all of which can materially change value. So updating or refreshing the valuation at these various points and stages, that shows good governance and ultimately reduces compliance risk. These are the things that make a valuation both defensible and compelling.
And, just big for me and big for companies that are operating, in the MSOPC structure, the management fee is just so critical.
Yeah, that's a big one. That fee, again, to reiterate, it really needs to be set at true fair market value. If it's off, either too high or too low, you're going to distort the MSO's revenue for investors, and you're going to trigger regulatory issues as well as tax issues. A clean FMV in that area is going to keep the valuation solid. It's going to also keep the structure compliant.
And what about forecasting? Everyone points to trends like we discussed earlier, but telehealth growth or AI adoption.
You can use trends, but they need to be grounded in real data, overly aggressive projections can hurt credibility and diligence. It can also raise questions on the compliance side. A set of assumptions that's stress tested shows restraint and maturity.
And again, worth reiterating, I think equity compensation is another area where this is just, hugely important and, really can make the difference between, how employees view the business and how you're able to retain some of your top.
It does. Again, you need the strong documentation so your employees feel confident and so you don't get pushback from regulators or auditors. Clean records also make hiring and retention way easier.
So what's the closing point here?
Treat your valuation as both a strategic story and a compliance document. The best companies in this space can balance ambition with defensibility. Now, that's ultimately how you're going to attract capital.
Yeah, totally couldn't agree more, Taylor. And, my big takeaway from today is, valuation in digital health. It's a measure of trust, compliance, defensibility, long-term scalability, everything from your algorithms, data strategy to your MSOPC structure, reimbursement readiness, equity compensation. It all flows through valuation. So you get it right, and you attract capital, talent, and strategic partners. Get it wrong, and you can create risk on multiple fronts. In a sector as regulated as high stakes as digital health, thoughtful, well-supported valuations, are one of the most powerful tool a company can have.
I agree. Build defensible assumptions, document everything, and let the valuation be the bridge between innovation and sustainable growth.
Well said. Well, thanks for your time, Taylor. I think we gave a lot of helpful resources here for some of our digital health founders and CFOs, and we'll certainly look to do more of these.
Thanks for the time.
And if any listeners have any questions, please feel free to reach out to Taylor or myself. We'll link our information below in the caption.